Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. Normally when I share videos, I always talk about, just the fundamentals and see if these stocks that I own or maybe talk about, if they are overvalued, undervalued. And I try to give you an idea of where I'm at and if I'm adding to it, if I'm buying it, if I'm not happy with it, whatever the case, I've always shared it. I'm sharing my journey here, so I want everyone just to know that I'm not a financial advisor. I just want to make sure that everyone understands that. And obviously, I'm just sharing my journey, but at the same time, I'm also sharing my knowledge on what I know about the stock markets and certain individual stocks. So if you like that kind of videos, if you like that kind of content, I would absolutely appreciate if you can give this video a like or any other videos that you've watched and subscribe to the channel, because it definitely helps the channel to reach more to reach out more people, hopefully. Right, so that's that. Today's video we are looking at AMD, Advanced Micro Devices. This company has come down almost 30% since the beginning of this year. Just like the tech stocks is actually down quite a bit. So if you look at in the last 3 months, for example, as you can see, where's AMD? There we go. AMD about 26, almost 27% down just in the last 3 months. And when you look at tech companies like Nvidia, for example, Qualcomm or whatever, Adobe's, they are all down around that same amount or even more, some of them. Okay. And so I want to share with you guys, we haven't spoken about it in a while. I want to basically check out if it's undervalued at the moment and if we should add it to the portfolio or not. Okay, that is the plan. So I'm sure you know what the company does. Okay, it's in the semiconductor sector. Right now, the company is basically trading $106 per share. Obviously, they make the CPUs and GPUs, and that's basically used in some of the very well-known products out there like Sony PlayStations and Microsoft Xboxes and so on. A lot of the PCs like HPs and so on, they also have AMD chips and so on. So yeah, that's that. Right now trading $106 per share. It has a PE of 41. Okay, no, the market right now, the sector is about 25. Now I've added one more thing here called price to free cash flow here, and what this means is it kind of helps us. Instead of using PE, you can use price to free cash flow to understand if a stock is undervalued. And so let me quickly show you what it looks like. Okay, so price to free cash flow here says is a equity valuation metric that indicates a company's ability to generate additional revenue, and that's very important. Okay, it's calculated by the digital and dividing this market capitalization by free cash flow values. Okay, so the free cash flow divided by the market capitalization, for example, or market cap divided by free cash flow will give you the price to free cash flow. And it says here a lower value of price to free cash flow indicates that the company is undervalued and its stock is relatively cheap. Okay, a higher obviously means the opposite. So the reason I added this, sometimes PE, we use PE when we want to compare it with the markets and so on. But if you're really interested to know how much free cash flow this company is creating and in relation to the price, okay, you want to find out whether the company is cheap or not, the best thing to use then is price to free cash flow. So less than 20, just like PE is what we're looking for. Okay, right now, as you can see, is 42. So according to PE, according to price to free cash flow, it is expensive. Okay, but I will explain that a little bit further in a second. So the market cap is $173 billion. Economic moat is a narrow. Okay, normally we're looking for wide moat businesses, but a narrow is okay because some companies actually, it depends on the product they create and whether they have a competitive advantage. I don't think they have a competitive advantage because there are companies out there like Intel who's not doing great right now, but maybe in the next 5 to 10 years will come back. So that's probably one of the reasons it has that. Okay, and then when it comes to dividend, they don't pay any dividends, so we're going to ignore all of that and then jump straight to free cash flow. This is now the money that they've got in the bank that they can potentially use to pay you dividends if they wanted to, or buy back shares or reinvest in the company. Okay, beta is quite high, so 1 point above 1 is normally volatile. That's why whenever you see AMD trading, for example, per day, it actually goes up about 1%, down 2%. There you go. Just yesterday, I think it was down almost 4%, whereas companies like Intel was only down about 2%. Okay, and again, that's a normal thing for this type of stocks anyway, because it's high when it comes to high growth businesses. Current ratio above 1, which is very good. Okay, that means the next 12 months they have no problem paying back their debt in the next 12 months. Profit margin, so this is where it gets interesting. Okay, profit margin is up 19% at the moment. Return on equity 47%, which is absolutely brilliant. In terms of quarterly revenue growth, so we're looking at basically we're comparing the current the recent quarterly report to the last year, this time last year, so year on year. That's 49% up, which is really good. Then quarterly earnings growth, okay, so this is the earnings, that's the revenue, okay, there's a difference. The earnings is down 45%. And I looked at them, like, where is that coming from? I haven't basically answered that question yet. I think we need to look at their latest report and see what's going on there. But it looks like their recent quarter was not as good as last year's. Maybe because we were under COVID situation, maybe the stock was doing absolutely amazing. The company was doing amazing because of the bullishness that was going on. At the same time, people were locked away buying products like the PS4s and all of those devices. Okay, people needed more devices because they want to connect online and zoom out with Zoom and all that stuff. Maybe for that reason, that's probably why this is down now. So in comparison to last year, it's down. Okay, so that could be one of the reasons. I haven't checked that yet, but if you're interested, go to the company's investor section and look at the latest revenue in comparison to last year and find out basically maybe why that is happening. So I was doing the research last night and I found out this was a little bit interesting. Okay, growth estimates for the next 5 years. So this is per annum. We expected almost a 30% growth from the next 5 years, basically. And that's really good. So every single year in the next 5 years, the business is expected to grow basically 30%. Now, when you think about 30% and you got companies that grow like 2, 3, 4, 5%, okay, and you're looking about 30%, that's the reason why the PE is so high. Because people are paying for higher multiples in order to get this type of returns. And that's the risk that you're taking. If you were to purchase this company now, okay, with this type of PE, basically you're risking, okay, you're taking a risk, but the reward might be amazing because you're going to get 30% growth in earnings growth in next year, which next 5 years. But the interesting part was, okay, in terms of valuations, according to Simply Wall Street, is 32% undervalued. I've never seen them being bullish on this company, so that's very interesting, okay. Then they have a target price of $156 per share, and right now it's $106. So it's got like $50 upside, if you like. I think it's a buy right now, but let me continue and I'll come back to that in a second, the buy bit. Morningstar, on the other hand, according to them, is right now it's 18% discount. So that means it's actually undervalued. They expected the price to be $130 per share. TipRanks, on the other hand, says 44, almost a 45% upside, and they expect the price to be, by the end of this year, $154 per share. So this is interesting. So you've got higher multiples, but you've got high growth business that didn't do well last quarter. Hopefully it will probably be better than this coming quarter. Okay, because if you're comparing it when we were locked away, that's not a good thing. It's like basically comparing Zoom's last year's Zoom's reports from last 2 years in comparison to this year. It's not going to be the same. We're not using Zoom anymore. We are basically going back to work. So growth estimate though for the basically 30%. So if you're interested in this business, this is the decision that you have to make. Okay, are you willing to pay higher multiples? Okay, for this type of growth, or are you going to be patient enough to wait maybe until this stock comes back down maybe? Okay, because if you think about it, not long ago, okay, 17th of May 2021, this stock was trading about $72 per share. According to this chart, it looks like it's heading that direction. I don't know if it's going to find a support here or below that. I don't know what's going to happen. Okay, but it doesn't look like it's going to stop anytime soon. And because of the volatility in the market right now, I would not be surprised. There's so much uncertainty right now. Interest rates are going up. The oil situation is going on with Russia and all that stuff. And on top of that, you've got inflation. So I wouldn't be surprised if we see more volatility and the stock comes back down to maybe about 70s, maybe 71, 72, 74, 5s, whatever. Maybe find support here and then kind of bounce back after that. Again, I'm just speculating, okay? I'm not a technical, I don't like talking about the technicals, but I'm just showing you where it was, okay, this time, I mean, May of last year. Okay, $70 per share. What is going to stop that basically going back down to that sort of a level? Okay, so that's just my opinion of what I think. But yeah, it looks like it's a great business. I've always said this AMD. I used to own it. I made quite a bit of money when early on in 2000 to 2020. But since then, obviously, it's been really overvalued, and that's the reason why I have not added to my portfolio. But according to what is it called? Simply Wall Street, as you can see, is actually quite undervalued, and the future growth they're expecting about 21%. And then when you look at Yahoo Finance, they're actually expecting the business to grow, their earnings to grow about every 5 years, basically next 5 years, almost 30%. And when it comes to them, they think it's $151 per share. That's where it should be by the end of this year. Okay, and according to them, you've got 6 people that said it's a buy, 5 that said is a strong buy. So together you've got about 11 buys there, and then about 15 hold there. So for me, although I'm kind of tempted, I think I'm gonna wait. And the reason I want to wait is because of the volatility in the market right now. It's a great business. I would love to own it and then forget about it and hopefully see what happens in the next 5 to 10 years. But right now, because of the volatility, I'm just going to be on the side and add it to my watch list and see how it goes. I hope you enjoyed the video. Assalamu Alaikum. Take care.